This. Welcome to Commodity Trading School. I want you to visit the website. Well, obviously you guys have because you signed up. Today's class is on beginning technical analysis, which will take us on a first step. This is Commodity Trading School in Las Vegas, Nevada. There's a toll-free number, a local, the email address. This is usually the best email address, though. Yeah, I gotta figure out where this goes. It's supposed to be forwarded to this, but I don't know if it is. Okay, trading futures and options carries a substantial risk of loss. This is not investing. This is trading. Past performance is not indicative of future results, and any decision to trade based on the information in this presentation is going to be the responsibility of the person authorizing such a transaction. Any reproduction or rebroadcast without the express written consent of Commodity Trading School is strictly prohibited. My partners, Gecko Software, Land Turner, they're very protective. All trade recommendations and illustrations are being presented using a demo account. Results are not being taken from a live account, and in some circumstances may not represent a fully accurate presentation of the current market and trading conditions. You guys can hear good, you can see good, correct? Okay, this is more about me. I started Commodity Trading School in 2003, got the web 2004, I don't know, so long ago. Anyway, I've been in the business for over 30 years. Well, actually, I retired from the brokerage business. I'm now just doing education. I started in 1983, which made it 36 years. Now, this business as a broker, the average life of a broker is less than 2 years. So I either overstayed my welcome or I know what I'm talking about. Oh, wait, we gotta go back. Give me 1 second, let me edit as I go. I'm no longer part of RCM, I retired. But over the last 36 years, I've been a regular contributor to various industry publications. I've been profiled in magazines, I've been on the cover of magazines, television, the whole bit, very full brokerage life. I wrote a book called Commodity Options. Okay, let's start with this, part one. What is technical analysis? Now, a lot of people think that in order to trade, you need to know a lot of stuff. Like you need to know the name of the farmer who planted the corn. Nah, not true. The numbers don't lie. Technical analysis is the means of studying prices, the numbers, and therefore trying to predict market movement based on identifying patterns represented on a chart. The basis for this approach to the markets is logical. The price of a commodity already reflects all known information as well as the opinions of each trader in a market. In other words, is it too hot, too cold, too wet, too dry, too? Therefore, fundamentals are already priced into the market. Now, over time, prices will begin to develop both long-term and short-term patterns. This makes sense since prices are not random. They're a collective reaction to all market participants. You can see these patterns develop by studying charts. Charts are the foundation of technical analysis. A chart is used to form a picture of a price, combined with volume and open interest. Now, they say a picture says 1,000 words, and that's very true in this case. Now, used in conjunction with technical indicators, patterns emerge that can be used to help forecast future market movement. While there are many types of charts, one of the most commonly used is a bar chart. For intraday trading, a 1-minute time increment is generally used. There are also daily, weekly, and monthly charts that can be used to form a longer-term outlook. Give me 1 second. I forgot to do something. Hang on. I want to open up this other book so we can flow right into it. Sorry about that. Okay, before we get started, we're going to be using a bar chart. There's many different types of charts. There's line charts, there's candlesticks. Every time I turn around, there's a new type of chart. But here's the standard chart, a bar chart. On a bar chart, it'll tell you where the market opened for that time increment. Each bar on a chart is a time increment, whether it's a 1 minute or 1 day or weekly or monthly. So you see where the price opened and where the price closed and what it did between the open and the close. You have a low and you have a high. Now the depth of the bar gives you a trading range for that bar. Each bar again is an increment in time. Now once you understand the basic elements of a bar chart, you begin to look at some charts to see how formations are read and what they can mean for the future price movement. So let's talk about that. We're going to go look at basic chart formations. Now, I've been doing this for a long time, and I learned in 1983 when I started, I read all the books about technical analysis, and some of them were written back none of them were written 100 years prior, but a lot of them had been written more than 50 years prior. So this stuff doesn't change over time. It stays the same. The pricing changes, but not the chart formations or chart patterns. Okay, let's first talk about support and resistance. This is the most basic charting formations. The most basic charting formations are support and resistance. These are areas in which the forces of supply and demand meet. Remember, we're trading commodities. You've got your producers, you've got your users. Oh, time for a drawing. The farmer is a producer, and the Kellogg's would be an end user, let's say Kellogg. So you got a farmer here planting corn, and he's looking to grow it to sell to the user. So you got the commercials and they're both commercials, but you've got the producer and the user. Any questions so far? You're mesmerized, right? Okay, support is the price level at which demand is believed to be strong enough to fend off further selling. Similarly, resistance is the area in which selling pressure is likely to prevent further gains. So you've got support, which is a good buy according to the buyers. Then you've got resistance, which is a good selling place for the sellers. Now the same person goes from being a buyer to a seller, the trader. For some reason, this is blank. We're going to skip these. We'll get to these again. Okay, let's start with a triangle or wedge formation. A triangle or wedge formation usually forms during a trend and is considered to be a continuation pattern. However, be aware that there are instances in which a triangle marks a trend reversal. This is a triangle. Now, if you want to get real picky, it's a descending triangle because you have a series of lower highs and constant lows. So we'll refer to that as descending triangle or wedge. A triangle and a wedge are pretty much the same thing. You say tomato, I say tomato. Then you have an inclining triangle or wedge. Now, this doesn't give us any direction yet. It's the breakout that will. An inclining triangle wedge has a constant high, consistent highs with rising lows. Typically, when a market consolidates in a triangle or wedge pattern, the price will break out of the formation with momentum. Accordingly, many traders choose to straddle the market using either options or bracket the market using entry stops in the future. Here, let's go look at this. What does that mean? Well, you've got your option traders that would buy a call here and buy a put here. Now, that's feasible, although not it's a feasible strategy. However, your risk is actually double because you have the trade has to overcome the cost of both options. Most traders look at a triangle wedge, square it off, making a flag, and would buy it above this high or sell it below this series of lows in a futures contract. Because a triangle or wedge can usually turn into a flag. Flags look like flags. Typically, when a market consolidates in a wedge or triangle pattern, the price will break out of the formation with momentum. Because what I just showed you with the futures trades, traders will be lining up above the formation to buy it, and sellers will be lining up below the formation to sell it. This increase in buyers or sellers will push the market, causing a breakout, which is a surge, either higher or lower, depending on which way it goes. Accordingly, traders may choose to straddle the market using either options or bracket. We already read that. We mentioned the option straddle. Here's what it looks like. You've got a market doing a wedge pattern or triangle pattern. So they'd buy a call above the market and a put below the market. Now, like I was saying before, you have to overcome the cost of participation, which sometimes can be expensive. But it's effective. I mean, if the market goes up to, these are your break-even lines, the yellow horizontal lines, you'd have to go way up here or way down here. It could happen, but it's usually pretty risky because the market doesn't make it. If you choose to straddle market using options, you're actually going both long and short at the same time, something you can't do in the same month futures contract. Many traders think this methodology either alleviates or reduces the risk of trading, when in reality it doesn't. It actually increases the amount of money at risk due to the fact that the market can continue to go sideways, or even if it makes a directional move, it may not reach the trade's break-even point. In this strategy, there are two options as well as two commissions, whose costs need to be considered. The combination of two option premiums as well as two transaction costs pushes the trade's break-even points further from the strike prices than if you choose to just buy a put or a call. You guys follow me so far? Any questions? Now, here's an example of bracketing the market using stop orders. A stop order in a futures contract is an active order, but not an active position. They're waiting for to get elected. So in other words, the price has to go to that price, the market has to go to that price for the stop to be activated and moved into a position. So in this case, we've identified a sideways market movement, a channel. We're putting a buy stop above the market, sell stop below the market. Going to take whichever way it goes. Another entry technique is based upon a breakout trading methodology, which we just mentioned, where you place stop orders above them and below the market's perceived range. The trader would place an order to buy the market on a buy stop above the market, as well as an order to sell the market on a sell stop below the market. Until the market reaches one of these orders, the trader is flat or not in the market, which sometimes is the best trade. Hang on one second, I gotta shut the mic. Now be aware of two things. We have seen both of these orders get filled in the same session, like the market does like an explosion up and down, getting the trader in and out of it with a loss. And two, the second thing, in futures you cannot be long and short in the same contract. Many traders would use the unfilled order as a stop loss once one gets filled. So let's go look at that again. So in other words, if, let's say this market looks like it's coming down, the moving averages are pointing lower, and if it did continue to go down, this order would still be working, and a trader would usually just drag it down a little bit, adjust it, using it as a stop loss. So it's a feasible way to trade. Let's talk about flag patterns. Flag patterns are also considered to be a period of consolidation before the continuation of a trend. That usually sounds a lot better. Here's examples of bull flags. This is actually a pennant. This is a flag, but it doesn't matter. They're both the same. They just look different. These are bull flags. The market moved up, but then consolidated sideways, trying to justify where it's at. Get comfortable. And these are bear flags and bear pennants. Okay, let's talk about another formation, a head and shoulders formation. Unlike triangles and flags, a head and shoulder formation is generally regarded as a trend reversal pattern. Typically, penetration of the neckline triggers an entry. Here is an example of head and shoulders formation. You've got a left shoulder, you got a head, then you got a right shoulder. What makes this, qualifies this as a head and shoulders, you have one high point. Up, down. I don't know. They say it's a head and shoulders. You got your left shoulder, your right shoulder, but your selling point would be below here, in my opinion. If you want to be aggressive, you can sell it here, but conservatively, you'd want to sell it here, below the lowest point of the formation. Okay, this is a head and shoulders top. This is a head and shoulders bottom. It's doing a handstand, I guess. Hang on. Okay, moving from the head and on the head and shoulders bottom, you'd buy it on a break of this high here. Any questions? A triple bottom occurs when a market attempts to break a common resistance level 3 consecutive times. Such a formation may provide traders with an attractive buying opportunity. What makes it attractive? The market keeps bouncing, so it's showing you that there's buying. Every time it goes there, there's buying pressure. Let's go to a 1, 2, 3 top or bottom. A 1, 2, 3 bottom or top cannot be identified when a market trading near annual highs or lows. A 1, 2, 3 bottom formation anticipates a change in the trend on a break above the number 2 point. Similarly, a 1, 2, 3 top anticipates a bearish market reversal. Where's my examples? Hang on. Let's go change this real quick. See, actually, there's a 1, 2, 3 top. Okay, looking for a formation here. 1, 2, 3 top. 1, 2, 3. Now, usually it helps identify the third point with if it corresponds with a Fibonacci scale. Market takes 2 steps forward, 1 step back. Either 50, 61.8, or 76.4. Now these lower numbers are Elliott wave numbers, but they still are valid. But at 1, 2, 3, this is what we're expecting the market to do. It goes, sells off, retraces, or digests, and then falls. Or it should, but you have to wait to see. That's why it's so speculative. Any questions? Is wheat setting up a 1, 2, 3? I don't know. Let's go look. It could be, it's kind of in no man's land. It's drifting sideways. And depending on what it does next, we'll give it a name. 1, 2, 3 top or bottom. Because like right now, it's not showing any real direction. Oh, so the jury's out. Sometimes markets get into a place where there's no clear trade. Here the market looked like it was going to break out to the upside. Sold off, came back. The close, I always look at the close of the bar, is below the 76.4 bearish count. Meanwhile, back on the farm, you look at it. You could also look at it this way. That's because you got to look at it from both sides. Wait 1 second. Look at this. Big bars. Now that was a bearish view. The bulls are looking at it this way. The bulls are going like they're justifying their position by going A, B, C line, 50%. Remember, market trades in a zigzag pattern. So this fulfills that. So yeah, you could be saying it's setting up. It's not a clear bullish or bearish market. It's a drifting market. However, don't give up. Watch this. We'll use a little magic. This happens to be harvest. So it could go lower, but doesn't look that exciting. This is a seasonal indicator. So the jury's out. Did that answer your question, Pam? Okay, let's talk about a sideways channel. A narrow sideways channel is a formation that features both resistance and support with a sideways market movement. Support forms a low price bar while resistance provides a price ceiling. Again, we got to go back to the charts. Which way is wheat going to go? We don't know. Let's go look at soybeans. Really? Okay, we'll fix it. Did I fix that? No sideways channel here. Looking at corn, a lot of the markets, like with all this stuff going on, what's going on? Sanctions, government, trade. It's like a trade war. I don't see any good examples of narrow sideways markets. Let's talk about a double top or bottom. Now, they say this is the most reliable chart formation. Wouldn't that make a triple top or bottom even more reliable? But no, this is called one of the most reliable chart formations. A double top or bottom may indicate a trend reversal. This formation includes two distinct tops or bottoms and is considered to be the most reliable chart formation. In review, we learned what technical analysis is, the definition, charts, and how to read them, basic chart formations, support and resistance, triangle formations, flag patterns, head and shoulders, triple top, and we're going to be doing all this now not in a live, but an end-of-day example. So let's go do this, close this.